This is a bond problem like all others. So 916 means we have to start doing some figuring before we do some figuring. Let's make sure we know what we're talking about with this bond. We handled this company before with another problem. This is a different bond problem. The company Splash City, and they issue $500,000. So the face value of the bonds are $500,000. Okay, and they're 9% bonds, 20 years. And let's see what else. This is 916. I don't know if I said that earlier. 916. 20-year bonds. They pay interest twice a year. So what else do we need to know? They're sold in the market at 10%. So that's their coupon rate. The market rate is 10%. So we know our bonds are going to sell for a discount because our bonds are paying less than the market is. So we need to mark our bonds down so people want them. And we have to figure out our annual interest payments. So that's $500,000 times 9% times 6/12, because we pay it twice a year. So when we do that, each interest payment that is mailed out is $22,500. That's how much we're going to send out. It doesn't ask you to value the bond. It tells you that because of the discount and the difference between our rate and the market rate, the bond will sell for $457,102. And if you want to work it out just for practice, you will find that it does indeed do that. The cash paid every period is going to be that. So we might as well just put that in and be done with it, because that's what it's going to be. It's never going to change. Now we have to figure out how much interest we should have paid. We have to figure out the market rate. And for that, we take 5%, which is 10% divided by 2, times the carrying value. So when we do that for the first interest payment on June of 18, it comes to $22,855 and a few pennies. The difference between that, $355, is the amount of the discount we're amortizing or applying to the bond. And when we do that, we come with $457,457. The next interest period, the end of that year in December, again we're going to pay out $22,500. Again, we're going to take 5% times the carrying value to come up with how much interest we should have paid, our actual interest expense. And when we do that, we come up with $22,873. And the difference between $22,500 and $22,873, which is $373, is the amount amortized. That gets added to the carrying value, and the new carrying value now comes to $457,830. Well, time flies when you're having fun. Here we are 6 months later. The next interest payment, again we're going to pay $22,500. again, we need to take 5% of the carrying value to determine what the interest should have been, and that's 22,892. The difference between them is 392. That difference gets added to the carrying value of the bond, and it becomes 458,222. Then we're going to have one more interest period. And again, we're going to pay $22,500 because that's what we're paying. What we should have paid, our actual interest expense, is 5% times the most recent carrying value. And that's 22,911. The difference, that 411, is the amortized value, and that brings the carrying value of the bond to 458,633. Now they say at this point they decide to retire the bond. And when they retire the bond has a carrying value of 458,633. We just proved that. And they tell us that the bond is going to sell for $601,452 because the market rate has dropped to 7%. So now the market rate has gone above what our face rate is, so our bond, which originally sold at a discount, will now sell for a premium. So we have to fill in this information. And we're told that the face amount of bond is $500. Each interest payment is $22,500. The market rate of interest is now 3.5%. Now here's the interesting thing. The number of periods is no longer 40 because we've already paid 2 years worth of interest, or we've made 4 interest payments. So at the beginning it was 40, n equals 40, the number of interest periods. But now the number of interest periods is 40 minus these 4, or 36. So the periods to maturity are 36. And when we do our calculator dance, bring that in a little bit so you can see it better. We find that this bond will now sell the present value of $601,452. $601,452. And that is exactly what the book tells us. How about that? They got it right. So, that's how much the bond will sell for in the market. $601,452. But they tell us at that point the bond is retired. We're going to retire the bond, and to retire the bond we're going to have to pay it back at that amount. That's what it's going to cost us to get investors to give us our bond back. And there's all kinds of reasons for doing this. This is not as rare or as stupid as it looks. On common sense, you look at it and say, why in the hell would you pay $600,000 for a $500,000 bond? Who knows? Maybe they have the money, maybe they want to get rid of the payment, any one of a number of a jillion different things. Doesn't matter the why. The reality, the accounting part of it is that's what we're going to have to pay. $601,452. So that's how much cash is going to go out. $601,452. That's how much has gone out the door. The discount on the bond payable also has to go out the door. And the discount on the bond payable is the difference between $458,633, the carrying value at the time, and $500. That's the unused discount. That difference is the unamortized, and we have to make that go away too. And that is $41,367. So the discount that's going away is $41,367. And all that is the difference between that and that. That's the amount of discount that's still hanging around that we didn't use. And now we have to figure out what our loss is on the bond payable, and we simply add these together and subtract for 500, and when we do that we find that our total loss on the extinguishment of the debt is $142,819. So again, a lot of this is just knowing which pieces to add and subtract, which piece goes where. You had to know how to find the unamortized discount or premium, which is the difference between the carrying value and the face value. You had to find out, you had to know how much you were going to spend. So you had to do a bond valuation at the time. Remember, this is when there's only 36 interest payments left, so this is not at the beginning. This is 4 years in, or 4 periods, 2 years in. You had to be able to do that. And you knew that the bonds payable was going to be a debit of $500,000. The difference between the $500,000 and the carrying value and the unused discount is the loss on the extinguishment of the debt. Lots of moving pieces, not difficult, but you had to know where all the pieces came from and where all the pieces go.